Good morning to you both. Alicia, I'll start with you. I'm looking at your notes. You say this is the hangover. What do you mean?
So, look, last year we had extraordinary fiscal stimulus, $5 trillion, much of it directly into pocketbooks, coupled with the Fed at the average inflation targeting stance, meaning it kind of ignored signs of broadening inflation during the summer and the early autumn. So now we're left with the fact that we've overstimulated the economy. We're frying in oil, and it's time to come back to more normalized levels of spending and growth. And so that's what's being reflected in the market, and the fact that the Fed is behind the curve, and the data have not been helpful in the last few months in thinking that the real economy can help inflation come down in the short term. So that's what we're left with, and that's what the market's reflecting, a kind of unpleasant range here between that 4,200 and 4,500 range, between that January 24th low and the 200-day moving average. It's just sitting here waiting to see what the next move is, either from the Fed or from geopolitical.
Ed, how do you see it, especially given the fact that the S&P has been range-bound really since the start of the year?
Yeah, I agree with that. I think that the S&P is going to remain range-bound for the next several months, maybe through the end of the year. I had been thinking at the beginning of the year that we could actually see the market up for the year. But now I think we're probably going to be quite lucky if it's just kind of flat for the year. And it's not just the Fed anymore. Obviously, it's also geopolitics. You know, geopolitical crises tend to be buying opportunities, but this one is a doozy. I mean, we've got some real serious action in Eastern Europe. The Russians have put together 150,000 soldiers. Look, the stock market has a tendency to climb a wall of worry, but I don't know if it does that when there's 150,000 soldiers on the other side of the wall.
Yeah, Ed, maybe you could elaborate a bit on that, because the buy the invasion playbook that some were writing over the weekend has, pretty arresting charts to look at. But the monetary and fiscal backdrop all around the world is a lot different than it was, say, in '91.
I think that's absolutely correct. The fiscal and monetary policies that we've had for the past 2 years worked to get us out of the lockdowns, but they were excessive. And as a result, we had a demand shock that's really started early last year. And that demand shock overwhelmed the supply system, and we've had supply chain disruptions. And I think there's been widespread hope, particularly at the Fed, that those supply chain disruptions would gradually ease, and that would gradually bring inflation down. But I'm seeing aspects of a wage price spiral now because the Fed has taken so long to act. It hasn't even acted yet. It'll do that in March. And so that's a concern. And this geopolitical tensions here, it's not just Russia. I think to a large extent, what we're seeing here is our botched exit from Afghanistan emboldened Putin to do what he's doing. I was very concerned to hear his speech. It was very emotional. It was very angry. Honestly, it was a little bit, off the wall in terms of just a historical gripes against the West. And so I'm very concerned that he very well could escalate the situation, depending on his kind of risk-benefit analysis. And guess what? The Chinese are watching the situation very, very carefully, as Morgan pointed out.